year.
I think that there is somewhat of a misread of the whole tax package. And, you know, I think there's a tendency to focus on the demand side stimulus and treat it like so many of the other fiscal stimulus packages we've had, which have been about boosting demand. Trump's tax package was very much focused on businesses increasing output, you know, this whole supply side stimulus, as opposed to being focused on the consumer and stimulating demand. And I think economic implications of that are very different. And so I think people who are expecting that this stimulus will not last are focused on, oh, well, the consumer's not going to have more money in their pockets from tax cuts going ahead. But you know what? Consumers have more money in their pockets. The reason consumers are spending now is because the job situation is so strong, because businesses have reengaged and are looking to boost output.
Well, that's the question, whether businesses have reengaged, and that's what everyone says, no, you're not seeing that in terms of business investment.
I mean, but go back through 2017, we had business investment that was strong just on regulatory relief. Yeah. In 18, you're right, the business investment has pulled back a bit, but what we've actually seen, as you talked about, Joe, much better hiring than we expected. I mean, the labor market is stronger. The pace of hiring exceeded even my own estimates, and I'm pretty optimistic. So I'm not saying that the economy is going to continue to grow at an above 3% pace. I think it'll slow a bit next year. Okay. But I just don't think that the fiscal cliff that people seem to be quite worried about, I'm not sure that
Beth Ann is nodding. I think you totally changed your whole opinion after that. Did you talk?
No,
okay.
No, I think
you
Joe,
still feel, okay.
Joe, you must see some of my reports sometime.
Yeah.
So anyway, so what we're looking for, we do think near term, we're expecting some, momentum is pretty strong. We're looking at fundamentals high. We have growth coming in near 3% this year and slowing, but we're looking at 2.3 next year, which is it's above trend. However, where we see concern and where we see the risk to the forecast is later out in 2019, earlier in 2020, where we see that fiscal stimulus start to filter out of the system. Our worry, of course, is, are we going to see the productivity boost that is hoped for, or are we going to just see more inflation for the Fed to fight? How much inflation are we talking about, too? Everybody says, yes, inflation is rather low, but how much do we need? I mean, what I think this was brought up. How many Fed hikes would it take to unravel the expansion? That would be a worry. Is it only 3? Already markets are saying one rate hike and stops there for 2019, or is it 2? Would that be enough to topple the apple cart?
So what the story, top of the Wall Street Journal, Fed may slow in. So what will happen today, based on the headline number and then the wage gains? What are you expecting for wage gains? Will that be hot?
For today, yeah. So we're looking for job gains around 200,000. We're looking for we're looking month over month 0.3, and we're thinking year over year holding at 3.1. We do think wages are going to slowly climb higher towards through the end of the year. We're looking, but nothing much. We're looking
that sounds
at 3.25.
manageable. That would be 200 with that. I don't think would spook the markets, would it?
The markets have got itself so worked up. There's a chance here that even if we get strong employment numbers, there's a lot of micro focus on the initial claims figures, which have begun to turn up. And the market I could even see the market wanting to discount any signs of strength as, well, it looks okay now, but going forward with these claims numbers moving out, will it be sustained? The market it's working itself up.
Market could be disappointed with either at this point. If it's too hot, it's the Fed. Right. If it's too hot, and if it's too cold, it's all the global growth concerns are warranted, and the housing and autos are telling us something. And now there's another shoe dropping with the employment. That'd be 3. Yeah. It'd be like a three-legged thing. Anyway.
Well, then you get back to, like we said, and I think that Paul, I do think is less sensitive to the markets in the sense of the Fed has to stay focused on the things that they can control. They have to stay focused on where they think the economic outlook is going, and they can't be sort of led around by swings in market sentiment. I mean, 2 months ago, I had 2 rate hikes in for the Fed in 19, and people were pounding me, oh no, the Fed has got to do a lot more. Look at what wages are doing. The risk is all to the upside. The economy had good momentum. And now, as we've talked about, we've taken so much expectation out in terms of Fed tightening. The markets are pricing in Fed ease by 2020.
They're not even certain that there's going to be a hike this month in December.
Exactly.
Yesterday, what was it, 73%?
Not 100%.
Not 100% like it had been.
So the swings in market sentiment back and forth, the best thing to do is, and I think the Fed is doing it, is staying focused on sort of what's happening. I do think, though, the question about do they need to continue hiking beyond December and beyond neutral, I think is a fair one. Without higher inflation, which we don't see, I don't know why the Fed wants to at this point in the cycle with some signs of slowing in autos and housing, et cetera, the global economy, why you do keep going into restrictive territory.
I mean, some of the things, so what we're expecting, the Fed has been saying in terms of their dot plots, they have a medium of about 3 hikes next year. What happens next week? Will they actually slow it down? I'm wondering if it's going to be a Goldilocks period for the Fed, meaning that 3 rate hikes might be a little too hot, 1 a little too cold, maybe 2 is just right. We'll see what happens, particularly next week. But I also have to say that the Fed is, we are seeing some slowdown, and certainly the Fed is watching housing because housing has a lot of weakness. Part of that is tied to the weather, horrible weather distortions that we've had. Can we see a turnaround on that? And I'm sure the Fed's paying attention to that as well.